A warm welcome to you all, to our members. We thought it would be a great idea to get some expert opinion on the budget that we all saw, watched, or heard about yesterday. And we've got our old friend Andrew Robinson with us here from Armstrong Watson and Co. Accountants. Andrew's a senior ag partner. We've worked many times with Andrew, and we're very grateful for the support that Armstrong Watson give us. They really do support the farmer network fantastically well. And Andrew and I often meet and take part in very many discussions and stakeholder groups and meetings as well. Always trying to give a positive message for farming. So welcome to you all. We've got some colleagues on here as well. Great to see Veronica here as well with us. And we're going to kick straight off then, Andrew. So in the summer, the Chancellor promised not to hike the taxes. I know you always tell it like it is. We were looking for some good news, particularly in the farming industry. Did we get it?
No, not really. I don't think anyone got any good news. I think sitting watching. Well, no, getting a what's the right word? An alert on my phone at 11:30 yesterday morning to say the budget had been leaked was quite entertaining. And if you use a bit of artificial intelligence, you could have it all analysed before she even stood up, which maybe was planned, maybe wasn't. But no, it was. I think it's fair to say that it wasn't as bad as we feared, if that's a positive.
Yeah.
Was there any good news?
I was going to say, you give us your brief overview of it, your take on it, and we'll sit and have a listen to that.
Yeah, well, it will be quick because I want to help folk with questions. So I think it wasn't as bad as we'd feared. There was a lot of the rhetoric and guesses and predictions for the budget, and they were going to further, amend how assets were gifted, the 7-year rule to 10. They were going to put income tax up. They were going to VAT, fuel duty. There was a multitude of things. So they were going to take away holdover relief. There was a lot of scaremongering it appears it's turned out that way. So in the end, it was better than we feared. That's all. The only positive that's come out of it is they've made life simpler for farmers and business people by making the new £1 million allowance transferable between spouses, like all other inheritance tax reliefs. So that makes life a little bit simpler to make sure you don't waste one, but it still doesn't have any impact on the really horrible family farm tax we've got. The other things, I think, looking at the budget, there was lots of little things, but the ones that affect the farming community are probably, if you run your business as a company and take dividends from next April, you'll pay 2% more income tax on that. If you let out properties and have rental income, you'll pay 2% more income tax on your rental profits from April 27, and on your savings income from 2027. So I think that's is it nasty? Yes, of course it's nasty to put tax up, but that's the one that's going to affect most of our farming clients. Apart from that, we'd all hope that she would change the inheritance tax, put the 1 million allowance to 5. I think we hoped, but we knew they wouldn't. So yeah, I think that's the summary of it, really. It's the 2% increase on tax. It's just making life more complicated, really.
Yeah, and that was a hard-worked victory, wasn't it, for the farming community? It's taken a year to get the government even to give that little bit in terms of the allowance.
Yeah, well, they've given us nothing really. They've just they've just saved having to plan around it to make sure both spouses gave away £1 million to use it against. So they've just made it simpler. They haven't reduced the inheritance tax farmers will pay by any stretch. They haven't made it any better. They've just made it slightly simpler for a husband and wife business.
some farmers in the meantime will have taken positive action, perhaps started to undertake property transfers, taken out assurance policies. Um, is that still something you think farmers should very definitely continue to be looking at?
Absolutely. I
Yeah.
think we have no choice but to try and do everything possible through the planning, gifting, life assurance, restructuring, whatever you want to call it. Every business, but we're looking at farmers today. Every farmer business needs to get on with that and do everything they can to minimize their exposure to inheritance tax, make it a sustainable amount at the very least, because it isn't going away. We've got, it was barely mentioned, was it, apart from the 1 million allowance yesterday. I think we have an opportunity. I was talking with one or two people in the northeast this morning, because it's still last year's Finance Act is still going through Parliament. And then it has to, I don't know how the process works, but it goes to Parliament, House of Lords, and backwards and forwards policy, doesn't it? I think we have to keep the pressure massively on MPs and our local MPs and our representatives to see if we can get some tweaks in the legislation as it goes through Parliament. But you can't rely on them, and the farm businesses need to crack on and look after themselves and do everything they can.
So we're open to questions now from everybody. You can either sort of alert my attention, perhaps if some of my colleagues on here can keep an eye out as well, because I can't see both screens. Please do raise your thumb if you know how to do that on the Zoom call, or we have the chat function as well, and you can put your questions into the chat. So, Andrew, are you happy if we have some questions from our members?
Absolutely. I can't. Wait a minute. I'm just switching the chat function on. Yeah, I'm happy for any questions. I will do my very best to answer them if I can.
You're a star, and we really appreciate the time you're giving us today. I know you're really, really busy for obvious reasons. Veronica, gotcha.
Hi, Andrew and Adam. Andrew, I mean, the only sort of crumb of good news out of yesterday's budget on inheritance tax was that £1 million relief being transferable to a spouse. I've just been trying to write this for e-news, and Adam said to me, "Oh, there's something about being able to backdate that for if your spouse has died recently." I don't fully understand it. Do you need to be married? If somebody has already died, maybe in the last year, can you still use that relief, or is it too late? Is there a cut-off date? Any explanation?
The first answer, you need to be married or in a civil legal partnership. So it needs to be a legal marriage or civil partnership, it says. So they will all qualify for the spouse inter partner transfer, is our understanding of it. What they're basically saying is if you've had someone die recently and before this legislation was introduced, before yesterday's budget, and they left everything, farming assets, left all the farming assets to the spouse, they would get the £1 million against their assets when they die. So if somebody's died recently and their spouse dies post new legislation, so post 6th of April 26, they will be able to claim £1 million, as long as their spouse hadn't given £1 million away at death. So you can't have it twice.
Is there a sort of a date of death? So say, I mean, is it like obviously it's got to be before yesterday, but I mean, is it 1 year, 2 years, 5 years since they've died that they might be able to transfer that million?
My understanding is it's just anything since last year's budget where the anti-forestalling legislation came in. That's my understanding at this point. Because if your partner, someone who's just passed away recently, you're still under the old legislation, or before last budget, you're still under the old legislation. But it's written in like everything that comes out from the government. It's hard. It's what was it, double Dutch type of things? Nothing straightforward. But yeah, you won't have lost it if you pass away under the new rules as the second spouse.
Thank you. I think there's a question in chat, Adam.
Thank you, Veronica. Yeah, there is. Looking at that now from James. He's saying, Andrew, will the mansion tax be payable by landlord or tenant? And will tenanted farmhouses, which are under FBT or Agricultural Holdings Act occupancy, be valued as if on the open market, or accounting for the fact that they are part of an agricultural tenancy?
I think the honest answer to that is we're still waiting for the detailed legislation. The one I can answer is that everything I've read and come out, it will be on its open market value. Now, I can't imagine the tenant having to pay it. So I would imagine it'd be the landlord. Obviously, I'm not a valuation expert and not qualified to give much view, but if it's subject to a long tenancy, that open market value of that big house is probably less than if it's sitting out on its own, owned by an individual, isn't it? Tenancies have a habit of devaluing things if they're long term. But it will definitely be the open market value as assessed by, I suppose, if the district valuer in the end.
So that, if I've picked it up right, is something that came in yesterday, whereby if you've got a property worth £2 million or over,
yeah,
it will be subject to what is being called the mansion tax.
Yeah, which is a flat £2,500 per annum on anything over 2 million, and I think it goes up to 7.5 on houses over a million, 5 million. It's just a flat charge. You may argue it's to appease some of his MPs that have been wanting a wealth tax, but whether it is or it isn't, I don't see. Is this only on a certain council tax band or any house? Our reading of it is it's subject to the question above about is it tenant or landlord. It is any residential property worth more than £2 million. And it will be a requirement to self-assess. You won't get a letter in the post saying you've got to pay £2.5 grand. It'll be your own responsibility to say, well, my house is worth more than 2 million. I better register and pay my mansion tax. I would fully imagine it to be a self-assessment role rather than the other way around.
And when's that coming in? Is that one of these ones that they've sort of delayed for 2 or 3 years? Or
yes, it is.
Right.
Don't quote me. I'm just, it's 2 years, I think.
Yeah,
I haven't got the relevant bit of paper on that one, but I'm fairly certain it's 2 years.
problem.
2027 sticks in my head.
Yeah. Bob Clark, how are you doing, Bob?
Oh, can't hear you, Bob.
Press the button.
Yeah,
Yes.
you there?
Just sticking with mansion tax for the moment, can I be absolutely clear? What we're talking about there is residential property, excluding land and the farm business assets.
The understanding at the moment is exactly that. It's residential properties, so wouldn't include farmland, farm buildings. What is included isn't detailed yet. So how much goes in for garden and curtilage, etc. I don't know, but yeah, the way it reads, it's your farm. If it's sitting on the outskirts of a farm, your farm buildings, your farm land and everything's not part of the 2 million. That's separate. But what is included is curtilage and I don't know, but there will be something for sure.
And where the farm has more than one dwelling, are they treated individually?
I think pardon me, the way we read it and the way it's been documented, it doesn't matter how many you own, you will have to assess all your residential properties and say, right, are any of them worth more than 2 million under the guidelines? I'll have to pay the appropriate person will have to pay a mansion tax on those properties.
That's fine. Thank you very much.
And I guess that is an interesting point, isn't it, on tenanted properties, particularly if you've got an Agricultural Holdings Act tenancy, whereby potentially occupation could be for a number of years or even decades. That will obviously reflect the open market value of the property. So that's going to be an interesting one for that to be teased out as time goes on.
Yeah, I think it's like a lot of these things. There'll be much debate and what is the correct value of different residential properties based on how they're owned, how they're used.
Great. Okay. Do we have any more questions? It's all quiet. Everybody's stunned.
Yeah. I think there's some, there wasn't a lot. What should businesses be thinking about? Those that operate as limited companies and have typically taken their income stroke remuneration from the company as dividends, because they were more tax efficient. I think with the extra 2% income tax going on to dividends, it's becoming very marginal whether you're actually just better taking a director's salary from your own company. The savings are fairly modest now when you factor in all the tax. So I think, everyone should just. I'm not saying it's not going to cost you. It's not a big change, but it's just swinging that one in the favour. Most of us most people, I say tenure, but most people have an ISA. So obviously from 2027, you can only invest 12,000 of the 20,000 allowance just in a cash ISA, i.e. a bank account. And if you want to use the full 20,000 allowance, your 8,000 of that has to be invested in stocks and shares via the ISA. So that's a little. It's not going to cost anybody any tax, but it's more hassle. It's potentially more risk in a stocks and shares ISA. That's for people under the age of retirement. If you're over 65, you can still use cash ISAs for the full 20.
But to be clear, if you're already paying into an ISA now and that's going to extend beyond those changes, nothing will change. Is that right?
It'll be using your ISA allowances from the change.
Yeah.
So if you've put if one of your saving plans has been to put 20,000 a year in ISA, from the 27, you'll need to put 12 in cash and 8 in a stocks and shares type ISA.
Okay.
And the question from Ben is, if you want to, there's nothing at all to stop you now or when the rules change to put your full £20,000 into a stocks and shares ISA. Many people have their full 20,000 per year in stocks and shares ISAs.
Yeah, just for those people on who are perhaps on the phone and can't see, that question was simply asking, can you use the full 20k in stocks and shares? And the answer is yes. Brilliant. Okie dokie. Anybody else? Any comments? Any questions? Feel free to shout up. We're all among friends here.
Bob.
Yeah, go again, Bob.
Totally abstract question. You'll be governed to £12,000 of cash in an ISA, £8,000 stocks and shares, except if you're over 65. If you get to 65 and you have those split ISAs, will there be provision to convert those into cash, which is what a lot of people do anyway, because the cash, if you like, is something they can draw more easily than stocks and shares, which they have to sell? Or I said it's abstract because I suspect they haven't even printed the answer yet.
Probably not, but I don't, you can convert your you can cash in your stocks and shares ISA at the moment. If it was within the ISA product and you wanted to change your stocks and shares into cash and you were over 65, I don't see why they wouldn't allow that, because you just turn it into full cash, which they've said if you're over 65, you can still use your full cash ISA allowance. I don't see that being a problem. So no question. Hopefully that's my best guess based on years
Okay,
of tax
that's
knowledge.
fine.
I think it's next question. Have there been any changes to pension contribution allowances? Yes, but they don't really affect the farming community as I see it. So making pension payments into your self-employed pension, or as a director of your own company and putting it into your personal pension, remains that you still get your the relevant tax deduction, either 20 or 40%, depending on what tax bracket you're in. They haven't altered the limits. The only thing they've done with pensions is for employees and companies who were getting pensions, who were putting contributions into their own pension via the salary sacrifice scheme. So they were sacrificing some of the salary for it to go directly into the pension scheme, and that saved national insurance. They've come out and said that any contributions into your pension of over £2,000 per annum via salary sacrifice will not get the national insurance reduction savings. So I think we all fear every time there's a budget that the tax relief on pension contributions will be changed for the self-employed and owner-managed business community. Fortunately, it hasn't had anything done to it yesterday. That's, of course, remembering that they've had a good go at it anyways by saying from 2027, anyone that has unused funds on death will be subject to inheritance tax on it. So you could argue they had a good go at pensions last year.
Mhm. Yeah, Veronica.
Sorry, I can't work out how to use my remote hand. Just going back to the inheritance tax changes, Andrew, there was, I think some farmers got their hopes up earlier this year that there would be more substantive changes and maybe an increase in that £1 million cap. I know when we had our recent Cumbria Management Council, farmers were concerned that there was a few farmers out there that have maybe been sticking their heads in the sand or hoping it was going to be changed or wouldn't happen. What's your experience working with your clients? Do you think there is a lot of farmers out there that still need to do something quite urgently now in the run up to that April 26th change?
Yes, I think it's not a majority by any stretch, but there is still some farmers that had hoped it would get changed in the budget. There is still the odd conversation, well, I'll hang it out so there's an election change and Mr. Farage or whoever gets in will put the policy, well, cancel the policy and put it back to where it was. I think that's very, I wouldn't be disappointed if that is what happened, but knowing what politicians are like, I wouldn't be relying on it to do my inheritance tax planning for my farm business was around hoping there's a change of government and they rescind the policy. So every farm or owner managed business should be looking at their own situation and what they should do. And it's different for everyone, but everyone has something to do. The 6th of April next year is when the new legislation comes in. It's a little bit of a red herring that everything needs to be done before then. I think the important things are that if you're wanting to if the situation is that you want to put assets into trust from your family business, that's better done before the 5th of April next year. If you want, the earlier you do the planning, the quicker you set off the 7-year potentially exempt transfer time limits. But if you're of a younger, you're not at retirement age, you're of a younger age and you own the farm and you're of good health and things, I don't, they shouldn't be getting too alarmed about it yet. They should be reviewing their fares, but I don't think the 5th of April is a big date for them. They should probably be reviewing the life assurance to say, okay, I'm 50, I'm fairly healthy, the kids are too young to inherit it yet. All things being equal, I should live another 20 years, but I'll take some life assurance just for that tragic event. So I think it's the farming families where the current landowners are 60, 65 or above that need to be doing something quickly to get the 7-year clock running. It's a 7-year clock that is the bigger deadline than getting it all done before the 5th of April.
Andrew, you and I took part in a pre-breakfast meeting up at Carlisle last week, and I did ask you this question, but people might be interested if they're thinking about it but haven't done anything. Have you seen a real uptake amongst your clients of people looking at insurance policies or assurance policies now?
Yeah. Obviously, as we all say in this brave world, I'm not qualified to speak on the actual terms and conditions, but yes, I think there's two interesting comments to that. Where farming families are busy gifting the land down a generation, so they're doing it now in life rather than what was planned via their will. The 40, 50-year-old or what a 30-year-old, whatever age the next generation might be, are taking out life assurance. So if anything, if the family died in the wrong order, so if the younger generation that should benefit from the gift had a tragic accident, got a tragic illness, there's a fund provided to pay the inheritance tax rather than having to sell the assets. So there's a lot of interest in that. And when you're younger and of good health, life assurance isn't that expensive. It's also quite interesting, and I think it's something we all think that once you're, over 60, over 65, a farmer, which is by life assurance is a dangerous industry, that life assurance will cost a fortune. Now, it is clearly much more expensive, but we looked, or I was talking with a client, wasn't a client actually, it was a prospector, it was a farmer down in Norton, and his mum had gifted him her half of the farm. She was 69 with good health record. And if she didn't survive 7 years, we'll say there was about 250 grand of inheritance tax to pay. And so I can't quote the figures, but I think the life assurance for the mum at 69 for 7 years only, so it was a fixed term, we'll say it was about 10 grand a year. So it was going to cost them 70 grand over 10 years to give peace of mind that if anything happens, they're not going to have to pay out 250. Now, to some people, that might sound commercial risk management. To some people, that might sound expensive. But what I'm trying to give is I wouldn't rule out looking at some 7-year life assurance for those giving the gifts. Because paying out 2, 3, 4, whatever the figure per year might be an awful lot better than having to pay out £1 million in inheritance tax. But yeah, there's definitely an uptake.
Without mentioning any companies, if farmers haven't looked at this at all before, where would they go for that advice? Is that something they would talk to for their accountant, a bank manager, or specialist companies?
You would. It depends who you're advised by. Many of us accountants firms have the financial advisors bolted on the side. The NFU of the NFU Mutual. You would have a chat with your accountant to work out what your exposure is to inheritance tax, and then seek either independent financial advice, or the NFU or one of those financial advisor firms say, right, this is what my inheritance tax exposure is. What assurance should I take out to cover it, and take their advice on the best policies and things.
Brilliant, thank you. Now we've got a testing question for you in the chat, Andrew, from Joe. What do you advise if your 50% owner is 85 years of age and you're unsure if they will survive the 7 years gifting rule? Is gifting still a good option for them? And these are the very people that the industry's been talking about to government for the last year, isn't it?
These are, this is why I've called it a tax on tragedy, because it's either tragic deaths in when you're totally unplanned, or when you haven't got, or there's a high risk you won't survive 7 years. Gifting, to me, gifting is still the option. So if you gift assets now and set the 7-year clock running, you will never be in a worse position than you are now. Because the worst case is that asset that you've gifted falls back into your estate and you're back to square one. But I'll put a couple of caveats on that in a minute. But if you gift and get past year 3/4, there is the tax starts to decline from years 3 to 7. Obviously, if you survive the 7 years, you're home and clean. So I would say gifting is absolutely the right way and get the 7-year clock running, subject to there being somebody to gift to. Are they old enough? Is it, I would say in all the planning we're doing, and I said this on the seminar Adam and I were on last week, it should be, what do you want to do for your family first? How do you want the business to look after your day? Who owns what's fair? And then fit the tax around it. But subject to that, gifting is the right way. And this is where the difficult ones are, and I have a couple of these. Obviously, if you gift land today, you are effectively under the new rules on that land. So that's fine. You set the 7-year clock running, and if you survive 7 years or 5 years, you're under the new rules. There's a difficult one that if you've got a relative or a landowner that's ill at the moment and may not survive till the 5th of April, you would be better not gifting any land and let it all go through the will under the old rules. Now, how would you judge that one? Our view is you work closely with your solicitor and maybe have all the deeds of gift and etc. ready to roll, but not signed and inked. And then February, March, it's horrible, but you assess granddad's or father's health. And if he's going to go past the 5th of April, which we all want folks to survive longer, you sign the paperwork to the last minute. But we have one at the moment where it would be the wrong thing to do to gift all the land, because if he passes away before next 5th of April, he's benefited from the old rules.
There's some really hard conversations that farmers and families have to have.
I don't think I don't. I can get very political if somebody passes a pint and I'm in a discussion in a pub, but I try. I've never seen, or I've got too many grey. I've been an accountant a long time, an agri accountant. I've just never seen a situation where it is just it's going to be a tragic event, whether somebody dies in their 80s or somebody dies in the 30s, that ends up with a horrendous tax liability. It's just not. And there's no, every other.
I think we've lost Andrew there, unless it's me. We will wait for Andrew to come back.
Yeah, it's not you, Adam. I can hear you fine.
Thanks, David. Okay, so we either talk amongst ourselves. We'll wait for him to come back in. I'll be watching the clock. In the meantime, we have got a couple of questions that have come in for him. Veronica, please help me out. Bail me out, Veronica.
I'm just looking at the SFI question, which I
Ah,
can make a stab at, and there will be others on the call that will probably know more than me. So I think Judith has asked, is there any implications for SFI agreements if you gift the land to the next generation? Um, I think the answer is probably not, but there may be others on the call like Jane and others that might be able to help. I think on SFI agreements, it's who has management control of the land for the duration of the agreement. So you don't necessarily need to own the land. So if the ownership has passed to somebody else through a gift, I think if you are still farming the land and managing it yourself for that 3 years, I don't think there should be an implication for that SFI agreement, but somebody else on the call can say if I'm right or wrong. I'll have a go.
Hi, Veronica, it's Jane. As it is at the moment, it goes on your SBI, doesn't it? So I think if ownership, like you say, is not an issue with SFI, unless you're passing it to a different SFI, SBI, sorry. So yeah, and the rules again are fairly simple of that. You'd have to contact RPA, and there are ways that they can transfer it over. But we'll have to see what the new SFI scheme, the new iteration is like next year, hopefully.
we wait with bated breath.
Yeah.
Sorry, my Wi-Fi vanished completely there somewhere into the ether. So, but I think the other, I'm not an SFI, well, I know a lot about it, but I'm not an SFI expert. I think another thing, a lot of the planning that we're doing for farming clients who operate as a partnership, the reallocation and gifting of assets is being done within the partnership. So the ownership of the ownership percentages and proportions of the partnership are changing, but the actual partners and partnership isn't changing. So it's still the same business farming the land, which should be a benefit to SFIs and all them sorts of agreements.
Brilliant. Thank you. And thank you, Veronica, for jumping in to start the answer to that question. We've got another question in the chat for you, Andrew. Quite a technical one, I think. Is capital gains uplift value not an issue in relation to the 85-year-old dying before 7 or 5 years?
Yes, obviously, if an asset's passed through your will, regardless of whether it's before the 5th of April or after, you will get your uplift to what it's. So the next owner's base cost for capital gains is what it's worth on the day of death. That hasn't changed. We feared that might be changed in the budget yesterday. Now, my view is you're only going to pay capital gains if you sell it someday. Now that could be a thing, but many farms, we know the next generation's taking it on, and none of us have a big crystal ball. But one of the unique things about farms is that they get drop to generation. So if you have no intentions of selling it, I would surely say it's better to try and save some inheritance tax, which will be incurred under the new rules, even if you get your capital gains uplift, than trying to get a capital gains uplift for something that may never happen, or maybe so far in the future the legislation will have been changed 3 more times and whatever. So Adam knows me, I say it, far too many farms have been held in the older generation because of the inheritance tax rules and because you got this tax-free uplift. And I've sat and, I've got clients that are still on it, but you'll sit and say, oh, well, I'll pass it via my will because I'll get the capital gains uplift. And you'll go, but 20 minutes ago, you were telling us you never have any intention of selling it and your grandson will get it. So the old legislation drove some not helpful behaviours, but it also the legislation was very helpful that there was no inheritance tax.
Very good. Okay. Any more questions?
There's a Mr. Pearson's put his hand up. Now I'm worried.
Well, We know Mr. Pearson. That'll be Mark from Oxbury Bank, is it?
It certainly is by the picture.
Come on, Mark.
Good afternoon, everybody. Andrew, I'll probably reiterate what you just said. If there's any good come out of the last year's budget, was it's promoted conversations around the kitchen table about bringing the next generation in. Have you seen, as Adam's seen, and anybody else on the call seen, we have seen a lot more partners, younger partners coming into the partnership, probably 5 or 6 years sooner than they would have done, also into land ownership in the last 12 months. And alongside that, have you seen many prenuptials? Because it's always a big question is, well, I'm not quite keen on his wife or his future partner. Have you seen many prenuptials being put in place?
I'll have a go at that first. The answer to your first bit is yes, there is much. There's definitely been more succession planning, and younger generations are coming in quicker. I would admit it. They shouldn't just come in to save inheritance tax. They should come in because it's right for the family and it's right for everyone in the future. So there's definitely been more of that, and they are been gifted land down a generation. But there's still, until this legislation came, there were still 55, 60-year-olds that didn't own the farm and granddad owned it, which you would have never seen in any other business, but it was driven by the inheritance tax. Pre and post nuptials are always a tricky subject. I wouldn't like to, if I'd owned a farm, would I like to go back to, or if I was being gifted the farm by my parents, my imaginary farm, and I went back home to Alison and said, oh, by the way, I want you to sign this before they'll gift it. It's going to be an interesting conversation. They are happening. I've got a client down in Yorkshire where the son was getting married, and as part of the inheritance tax planning, he's getting a big chunk of a farm which he works on. Was always coming to him, and they've done a prenuptial agreement that basically says what they make from now going forward is fair game. But the farm that's coming from previous his parents is out with any divorce settlement. So yeah, I think I heard a solicitor call them asset protection agreements. It's probably a nicer way to put them. They're not an easy subject. They have to be fair. I'm not a lawyer, but they have to be fair. I think to protect farms for the next generation, they can be a useful tool.
Yeah, I'm sure there will be a way of dealing with these questions in a very professional manner around the table, without causing offence. And for high value properties, it's obviously something that's really, really going to be worthwhile doing, I would think. Bob, over to you.
Back again. Just an observation, really. We've talked quite a bit about market values, but what one has to bear in mind is that it is the market value at the time of either the transfer or the death in the case of wills. It is not what things are judged to be worth as at today. In all probability, they'll be more valuable, but that doesn't necessarily follow. But I think the presumption has to be that they will be higher at the time things happen. But what won't happen is that the inheritance tax allowances won't be rising correspondingly. So the net gets tighter.
It's a very fair point. You're right, because assets, all things being equal, assets will increase in value, and the IHT allowances, so the 325 everyone gets, the 175 if you're attributable for your residential property, and the million are fixed. Don't quote me, but are fixed for quite a number of years. So therefore, as your asset grows, the allowances, you've got your fiscal drag, the allowances are covering left of it. I think so you're right, the only little interesting point that comes out of that, if you're gifting land today, the gift is based on what it's worth today. You die in 5 years' time, so you fail the 7 years. It comes back into your estate at what it was worth on the day of the gift. not what it's worth on the day of your death. So I would advise, well, I'm advising everyone to go and look at their own affairs, but especially clients. And I know there's some, we all love or hate solar, but if you've got a bit of land that might go for building development, might go for solar, might just have a massive increase in value because of something in the next few years, that you might want to get it gifted when it's worth farmland values and get it out of dad's, granddad's estate before the uplift in value. But again, everyone's different, but that's something to look at.
What you're identifying there, Andrew, is the real complexity of knowing your asset, understanding your assets, what they're worth, which has come back time and time again in this little segment that we've had, and who owns what as well, because sometimes for a lot of families that isn't quite clear as to who owns what.
It's you're the most 100% right. It's sitting with your accountant and your lawyer and saying, right, who actually beneficially for financial and tax purposes owns the assets, the land, the machinery, the whatever it may be, savings account, because it might not be what the title deeds say if it's involved with a partnership or a company. Bob's comment about valuations, it's the open market value on the date of death of all the assets you own. So whilst your cows may be valued on the herd basis for tax purposes in your annual accounts at 800 quid each, because it's a historic figure, correct in all ways, they're probably worth twice, three times that. So it's really assessing, work out what you own, what values there are, who owns them, and then what you ideally would like to do with them. Then worry about the tax. Don't tie your family in a knot trying to save all the tax. There's got to be some thought goes into it.
Yeah, and I think the comment, I'll come to you in a second, Tracy. The comment I picked up from you in the meeting that you and I attended last week was you just simply said 3 words: make a plan.
Yeah, absolutely. And don't wait. Make a plan. Do get your family sorted out in a manner that's fair and you're probably going to do via your will. And get on with it. And if the legislation's revoked in 3, 4, 5 years' time, you won't regret it, because you've just done what you were going to do via your will. You will regret if you do nothing, somebody dies, or the legislation doesn't change. You'll cost a lot of money.
That's great advice, Tracy.
Thank you, Adam. Hi, Andrew. And absolute brilliant session. Some really, really great advice. Thank you very much. This is more a reflective observation, really, particularly working for the Land and Nature Skills Service, where we're wanting to encourage younger people into the industry. And really, and if you've done some good work, but should part of the argument not have been that IHT was only applicable if the land was sold, so it wasn't penalising the younger ones that were wanting to come into farm?
Yeah, that's really good, because you go back a year, 13 months now, when this legislation first was proposed, and obviously comes in on the 5th of April. The first thing was to stop the Dysons, the Jeremy Clarksons, buying agricultural land, farming it in inverted commas, and then saving 40% inheritance tax on that money compared if they had it in the bank. So it was to do that, and also it meant that they said the legislation, where people buy a farm as soon as the next generation inherit it, they sell it, and there's no capital gains tax, so they've had the bid uplift. So that was the reasoning for bringing all this in. Well, it hasn't achieved any of that, because if you've got 10 million in the bank as rich oligarch, you can still, if somebody said to me, invest 10 million in that farm and 2 years later you'll have saved 2 million in inheritance tax. It's not as good as it was, but it's still very attractive. And if you get your IHT planning right, you can still get the farm, and it requires a bit of 7 years, but you can still drop the farmer generation, they sell it tax-free. It would have been far more simple just to say, right, tighten up on the farming rules, so you had to be farming your own land to get the inheritance tax. And if, like various bodies proposed, if they'd said, right, if you sell it within so many years of inheriting it, there's a clawback on the inheritance tax relief, or you pay capital gains, which would have meant farms that were genuinely going to youngsters and dropping generations could have gone in, but it would have protected the others. But it's just, and the frustrating thing, some of the people's like Dan Needle, who's a tax specialist who helped the government bring it in, Tax have done a report. There's been numerous of quality reports. I've actually said since last year, this isn't the best policy. There's ways of achieving the same without the decimation this is going to cause. But as we see over the last 12 months and again yesterday, they ain't listening, and I don't think they're even interested in listening, but I'll not get too irate about it yet. Save that for the pub on Friday night.
Absolutely. Okay, we're getting close to time, ladies and gentlemen, so I think I'll just ask for any more final questions, or please do give us your comments, because this is an open debate. Anybody, anything else for Andrew? It's all quiet.
Sick of hearing us.
Not at all. We'll never get sick of hearing you all, pal. So listen, let's bring this to a close then. After about 10 minutes of this, when you gave us your first little intro, I thought we were grinding to a halt. I thought this is going to be a long session. And then all of a sudden here, it's nearly 1:25 and the conversation has never stopped. And that's all we ever want to do with our members hour here. We've been holding them on a monthly basis over the last few months. We might well change it to as and when needed, like a budget. But if any of you as members have any ideas of sessions or topics you'd like us to cover in a members hour, please do get in touch with us, because we rely on your feedback to know what to do. I'd like to say a big thank you to Andrew. As I said to you before, we work very closely with Andrew and the rest of the team. I think I'm at your meeting next week, Andrew.
You are.
And it's great to see some of our other sponsors and corporate members taking part as well. And most of all to you, our farmer members, because without you, there is no farmer network. And hope you've had some benefit out of this afternoon's session. We'll send you a link in e-news for anybody else who might want to see it who hasn't been here. Just have to work out how we do that and get it onto our YouTube channel. But for now, can I say a big thank you to you all. Enjoy the rest of your day. And thank you, Andrew, once again for the time you've given to the Farmer Network. Cheers. Bye-bye, everybody.
No problem. Cheers. Thank you.